Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Today, we're diving into the U.S. market peripheral notes for March 18, 2026. Just so we're all on the same page, this video presents a direct informational narration of the source document. So here's our game plan for today. First, we'll look at how geopolitics is reshaping asset pricing. Then we'll tackle inflation and the Fed's policy. After that, we're on to the technical breakdown and panic positioning. From there, we'll examine gold's interesting shift to liquidity and look at some differentiated sector moves. And finally, we'll wrap it all up with a conclusion and response framework. Okay, before we jump in, we need to start with the initial risk disclosure. Now, this document is provided solely for informational and research purposes. It does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. You should know that investing in financial markets involves significant risk, and that includes the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments can fluctuate materially and unpredictably. All the strategies, market views, and analytical content you see here are presented for reference only. They are not trading instructions, portfolio management guidance, or guarantees of future performance. Any investment decision you make should be done independently based on your own financial circumstances, objectives, and risk tolerance. Remember, market conditions, liquidity, macro developments, policy changes, and just unforeseen events can materially affect performance at any time. And of course, past performance and historical analysis are not indicative of future results. The information in here might be time-sensitive and is subject to change without notice. All right, Section 1, Geopolitics Reshapes Asset Pricing. During the March 18th trading session, something pretty dramatic happened. Geopolitical risk completely overwhelmed the macro data flow. It became the absolute core driver reshaping global asset pricing. We saw market sentiment take a sharp U-turn, shifting from what you might call constructive digestion of positive headlines to a state of rapid risk transmission. So let's look at the timeline of events because it really tells a story. Early in the session, we had this sort of false sense of easing. Market sentiment got a boost from Iraq announcing it would resume exports through the Kurdish pipeline. Plus, U.S. strikes took out some Iranian missile positions, which briefly pushed crude oil down. But then, later in the session, things just completely reversed. Reports came out that Iran's South Pars gas field had been attacked, and that changed everything. Iran then threatened retaliation against Gulf energy assets, and just like that, the whole conflict framework escalated from a shipping lane problem to a real threat of damage to upstream production capacity. So, the deeper analytical conclusion here points to a big shift in the target hierarchy. What this means is that the energy premium is no longer about a short-term transportation disruption. No, now it's about a long-duration production loss. And while the White House was trying to emphasize that some limited shipping activity was still in place, the reality on the ground is that actual traffic volume has already plummeted by a staggering 98%. The potential scale of this disruption is huge. We're talking about roughly 15 million barrels per day of Persian Gulf production that could be at risk if this bottleneck continues. And just to put that number in perspective, that scale is 15 times larger than the peak Russian production loss we saw back in 2022. So you can see why the market really needs to reassess this structural upward shift in the global energy supply clearing level. It's a whole new ballgame. Okay, moving on to Section 2, Inflation and the Fed's policy. This energy shock is really hitting at a fragile moment, mainly because inflation is still incredibly sticky. We saw the February PPI data, and both the year-over-year and month-over-month numbers came in hotter than expected. It just underscored the tough reality that inflation has been above the Fed's 2% target for 5 straight years now. So, what were the key takeaways from the Fed's decision? Well, looking at their policy stance, the benchmark rate was left unchanged as expected, but they actually raised the GDP growth forecast. Their take on the Middle East situation was deliberately ambiguous. They called it still unclear. Now the dot plot guidance, that was interesting. It's pointing to just 1 cut in 2026, 1 in 2027, and 0 cuts in 2028. That outcome was materially below what the market had been expecting in terms of easing. Then you have Chairman Powell's remarks. He delivered a really key and frankly damaging signal with his statement, and I'm quoting him directly here. The possibility of rate hikes is back on the table. Let that sink in. Without any real, genuine progress on inflation, that window for easing policy has now effectively slammed shut. And what this all creates is a policy resolve vacuum, right in the middle of a transition period. You see, April is going to be Powell's final FOMC meeting of his term. At the same time, his successor, Kevin Warsh, is still waiting for confirmation. This caretaker cabinet-style policy setup, layered on top of a massive geopolitical shockwave, well, it leaves the market facing a pretty serious vacuum in both liquidity, confidence, and policy anchoring. All right, Section 3, Technical Breakdown and Panic Positioning. Look, the current index sell-off isn't just an emotional drawdown anymore. It is increasingly looking like a full-on trend liquidation, and it's being accompanied by some serious institutional position restructuring. So what's the logic behind the institutional positioning? Well, first off, Friday is triple witching expiration. Given the whole geopolitical mess, a lot of institutions decided to roll their short exposure on FOMC day. That's when liquidity was most abundant. This proactive supply just amplified the selling pressure, driving the S&P 500 lower in what was basically a one-way session. The index closed right near the lows, retesting that annual moving average. If we scan the technical setup, the VIX closed at 25, and the daily candle formed a solid up day. What that suggests is that the sell-off hasn't quite hit a true capitulation spike yet. Key downside support is sitting at 6,600 and then below that in the 6,500 to 6,550 range. Now, a break below the annual moving average would likely trigger a much deeper wave of quantitative liquidation, which would probably be followed by an oversold rebound back towards 6,700. Let's move to Section 4, Gold's Shift to Liquidity. Gold's move below $5,000 an ounce has definitely caught a lot of attention. From a strategy standpoint, the key point here is pretty clear. Gold's pricing logic is going through a major regime shift. We're seeing a shift from gold acting as safe haven beta to gold being used as a source of liquidity. It's really interesting. Since the Iran war broke out, gold and crude oil have moved in completely opposite directions. And with the rate path turning more hawkish and real yields on the rise, that easing discount that was embedded in gold has just been forced out. And this defines gold's new function. In an environment of extreme volatility, its correlation with equities can actually flip from negative to positive. It becomes what we call a passive liquidity provisioning tool. This is an asset investors sell to meet equity margin requirements or just to raise cash. It's a classic sign that the market is operating in a defensive phase, one defined by tightening liquidity. Okay, Section 5, Differentiated Sector Moves. Right now, capital flows are showing a pattern that is highly differentiated and, frankly, unusually structured. Let's look at this comparison between Micron technology and the optical connectivity space. In terms of pricing logic, Micron absolutely beat earnings decisively. But the thing is, the stock had already fully priced in that positive surprise. By contrast, look at the supply-demand setup in optical connectivity. Light has explicitly said that their capacity is essentially booked solid right through the end of 2027. That just highlights the extreme tightness in the physical layer of AI infrastructure. A little more sector analysis for you. In the consumer space, Macy's delivered Q4 earnings ahead of expectations, but it gave back all its gains. Why? Because management's guidance was notably cautious. And over in the cyclical sector, the fertilizer major CF Industries has surged an incredible 27.3% in March. But because urea prices have actually risen faster than oil prices, that trade is now looking over-discounted. And that brings us to our final section, number 6, Conclusion and Response Framework. The U.S. equity market is now moving through a pretty painful transition. We're going from a single-threaded, AI-driven market into a much more complex regime that's being shaped by geopolitics, reflation risk, and tightening liquidity conditions. So our framework conclusion is really threefold. First, the AI complex still has structural growth resilience, but consumer stocks are definitely showing weakness. Second, on policy expectations, the market has effectively lost its near-term rate anchor, all thanks to Powell's hawkish stance. And third, for the operating stance, well, a downside extension below the annual moving average now seems highly likely. With triple witching and an uncertain policy path creating this sort of double squeeze, the advice is to maintain a very high cash allocation. Investors should wait patiently for an opportunity to engage after we see extreme volatility test that 6,500 to 6,600 support band. At this stage, the key really is balance sheet endurance, not just blindly dip buying the left tail. And we will close with the final professional risk disclosure. Just to be perfectly clear, this document is provided solely for informational and research purposes. It does not constitute investment advice, financial advice, trading advice, or any kind of recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, a broker-dealer, a financial planner, or a fiduciary. No advisory or client relationship is created by the publication or use of this document. Remember, Investing and trading in financial markets involves substantial risk, including the possible loss of principal. All market views, analyses, and discussions are provided strictly for informational and educational purposes. Any investment or trading decision you make based on this document is done solely at your own discretion and risk. You're responsible for conducting your own independent research, verification, and due diligence. And as always, past performance and historical analysis are not indicative of future results. Market conditions can change rapidly, and the information you see here may become outdated without notice.